Hey, are you looking for a loan that is flexible with credit and has a minimal down payment? Then you might be looking for an FHA loan, and maybe everybody's telling you, just go get an FHA loan. But before you jump in, there are 5 things that you really need to know about FHA financing so that the loan helps you rather than traps you. I'm Peter Lindquist. I've been a mortgage lender in Minnesota for over 30 years. So let's break down these 5 things that you need to know. And number 1 is FHA is not just for first-time home buyers. So if you currently own a home or recently sold a home and are looking to buy again, FHA can end up working for you as well. You can own multiple pieces of real estate. So if you want to rent out your current home and buy another home FHA, that's possible. Now, if you currently have an FHA loan, in most cases, you can't have more than one FHA loan. But FHA is not a single-use type of program. So if you had an FHA loan before and you have paid that off or are going to pay it off prior to the closing of your new one, then FHA financing can work in that situation as well. So must know number 2 is that FHA has no maximum income limits. Though if you're getting a down payment assistance program along with it, that might, but FHA itself does not have a maximum income limit. For you in Minnesota, if we are doing a loan through the Minnesota Housing Finance Agency and your loan type is FHA, then yeah, Minnesota Housing Finance Agency has maximum income limits. We have to fit there. But if you've got your own down payment and are not getting down payment assistance, yeah, there's no maximum income limits. Must know number 3 is FHA is much more flexible when it comes to credit and credit scores. For example, if you've had a bankruptcy in the past, FHA only requires that at least 24 months have passed since the discharge of that bankruptcy, where conventional financing is 4 years. Or if you had a foreclosure, FHA only requires that at least 3 years have passed since the date of the sheriff's sale versus conventional, which is still at 7 years. It's also much more forgiving on lower credit scores. Conventional financing can get very expensive, especially under a credit score of 720. Conventional adds discount points based on your credit score, and it gets to be very significant the lower you get below 720. Now they go as low as 600 on credit scores, but by that time, realistically, FHA is going to be a much better deal for you, because if you're putting minimum down, you're looking at mortgage insurance. Mortgage insurance rates for conventional get higher and higher as your credit score goes down. FHA, it's the same. Whether your credit score is 600 or 800, the mortgage insurance rate is 0.55% of the loan amount plus a one-time fee that's financed on top of the loan, which is 1.75%. But either way, FHA is going to have a significantly lower monthly payment when we're talking about credit scores under 720 and especially under 680. They also allow for gifting. So 100% of the money that you need to buy the house can be gifted as long as it's from an eligible donor source, like a family member. Now, must know number 4 is that FHA mortgage insurance works differently than on conventional. FHA calls it mortgage insurance premium, MIP, as opposed to conventional private mortgage insurance, but they effectively do the same thing. With FHA, they charge mortgage insurance in 2 ways. They charge it as a monthly premium. So if you're putting minimum down, 3.5% down, it's 0.55% of the loan amount. Again, regardless of what your credit score is, it's 0.55%. And then they also have a one-time financed fee that goes on top of your loan. That's 1.75%. Now, that can be really significant. If you have a $400,000 loan amount, 1.75% is $7,000. And so if you have a choice between conventional and FHA and are approved for both, oftentimes, even though the monthly mortgage insurance is less expensive, if you take into account the one-time premium that's financed, it's possible that conventional financing is still less expensive. The other big difference for FHA mortgage insurance is that it is required for the life of the loan. It's required even if you have 20% as a down payment. Now, if you have 10% down or more, the monthly premium does go away, but it's 11 years after that, so you've probably paid it off or refinanced it by that time. Where with conventional mortgage insurance, that monthly mortgage insurance can potentially be removed once you hit at least 20% equity on the property. There's many rules that get within that, but it is a difference. If you're getting an FHA loan, don't expect that mortgage insurance to go away, and don't expect that with a large down payment, you're not going to pay it, because you are. Must know number 5 is where FHA really shines, but we're also going to consider a couple of landmines. So the main benefits are much more flexible on credit, a very low down payment, 3.5% down. It's great for house hacking. I mean, if you want to get up to a 4-unit property, you can potentially get in with as little as 3.5% down. It allows significantly higher debt to income ratios, where conventional is very unforgiving when it comes to that. Though that's not always a blessing, and that kind of leads into the landmine. Just because FHA can qualify you for a mortgage payment that is significantly higher than what conventional is, you really need to look at what your monthly budget is and whether that's something realistic for you. What I like to tell people is there's the mortgage world and then there's the real world. Mortgage world might say that you're approved, but in the real world, is it something that you approve and you feel comfortable that you can repay that loan? I want you to be a successful homeowner. I don't want to just be successful in getting you a loan. Probably the biggest thing that I would say is a potential landmine with FHA. In today's market, it is generally much harder to get your purchase offer accepted using FHA financing. If a seller has multiple offers on their table and 8 of them are conventional financing, 2 of them are FHA, quite often they're taking the 2 FHA loans and throwing them out the window. This really has to do with a couple of things. Number one, the seller knows that it's easier to qualify for FHA, so they're more worried about the financing, that it might fall through between the point they accept the offer and closing. And probably more importantly, they're worried about the FHA appraisal. So when you get an FHA loan, we have to order an appraisal of the property. And that appraisal is really done to determine the value of the home. If you pay $400,000, we need to know that the house is worth $400,000. But FHA also has some flashpoint issues like chipping paint. If the house is older than 1978 and there is any chipping paint anywhere on the property, including the shed out back, that has to be scraped and painted prior to closing. Well, sellers don't want to have to do work. But that being said, a lot of times you're using FHA financing because that's all you qualify for. And if that's the case, there are just tons of benefits to FHA. It also tends to have a lower interest rate than conventional financing. And so even though it might be tougher to get your offer accepted, if you're persistent, buyers are still finding success buying a home and using FHA financing to help them accomplish that. If you're buying a home anytime in the near future and you're curious about differences between FHA and conventional financing, subscribe to my channel. You know, I do these kind of comparisons and talk about homebuyer issues in general. Thanks for taking the time to be with me today, and have a great day.